to the Capital Discussions Roundtable. I'm Tom Nunemaker with our guest Andrew Falde from SMB Capital. Before we get started, a quick disclaimer that Capital Discussions is not a broker-dealer or an investment advisor. This presentation is for educational purposes only. You don't know your situation and have no way of knowing what level of risk is appropriate for you. We're not making any specific recommendations. The risk of loss in trading options can be substantial, so please be aware of all of your risks prior to trades. Hypothetical computer simulated trades are believed to be accurately represented. However, actual profit or loss may vary due to market factors such as liquidity, slippage, and commissions. So once again, this is for educational purposes only. So with that, you're welcome. It's great to have you back.
Glad to be here.
I'm sure everyone's looking forward to this. It'll be fun.
All right. I hope to satisfy their interest. I've had some conversations ahead of time. People wondering what I was going to talk about. I jokingly told one that I was going to talk about the correlation between lunar cycles and the VIX.
Okay.
And, but I haven't even told. I guess you kind of knew. Freestyle trading. That's what we're going to talk about.
Right. That's the subject.
Yeah. All right. So I should share my screen now?
Yep. You got it.
All right. Share screen. Waiting for the right one to.
I think if you go Control-Alt-D on Windows, it should pop it on there.
Yeah, I'm just trying to get the right one to highlight.
Oh, okay.
There's like a little delay in the. Well, you know what we'll do? We'll just go with the one I see here, and I'll move my stuff over. I should have closed some programs before I started this, but I can if it has any more delays.
Well, I'm looking at PowerPoint, so I think we're on the right track.
We're moving the right way here. So let's see if I get this to pop up on the same screen. It did not. And then I'll just move it over. I'm just going to have to zoom in on it. We'll just have to go that way. All right. So we're going to talk about freestyle trading, but the terms I kind of want to get focused on and communicate ideas about are these three words: risk, reward, and sizing. And then we can talk for 1 second about what's not on here. And that is, we don't have any names of a trade. So we don't have the butterfly trade, the M3, the iron condor, the Kevlar, the broken wing butterfly, all great trades that most in this community already know about, already have familiarity with. So what I'm presenting is what I have done a lot of research on, working with other traders, done a lot of work with, and have adapted to my trading over the last 18 months or so, which has produced positive results and, more importantly, less frequent management and less frequent and smaller drawdowns in trading by this style of trading and managing different types of profiles. And I believe this can be adapted to many styles of trading if it's a style of trading that aims for higher return on risk. That is, if you're trading very high probability credit spreads or iron condors, I do not think this style of management or risk reward setups and adjustments would work, but something like a butterfly, iron butterflies, unbalanced or broken wing butterflies, things where there's a T plus, not the T plus zero line, but actually the T plus a number of days, where further into the trade you can expect to see higher amounts of return than something that would be quote-unquote high probability or a low credit type of trade. So similar disclosures. This is for educational purposes. Everything's hypothetical, and you should review your risk disclaimers from your broker. All right. In trading, I'm going to zoom in so you can't look ahead. consistency is one of the most desired things. Traders at the earliest level of trading to the most advanced levels of trading desire for an improvement in their consistency. They want more consistent returns. And that's because they're not looking for their first time of making a profit, and they're not often even looking for making more returns or higher percentage returns on a monthly basis. That's very, especially in the options world, is not the topic that comes up a lot. What we're looking for is we want more months out of the year to be profitable. We want fewer periods of time during our trades to be down, and we especially want them to not be down a lot. And we want to be ready for multiple market conditions and market environments and make sure that we have consistent, predictable, reliable strategies for trading. And we often, and I threw in the word strategies because we feel like it's the pursuit of most options traders is to find the strategy or tweak the strategy to give them more consistency. And we see the symbols often used, the icons, logos, things like that, where it's a chessboard, feeling like it's a chess game and it's a chess strategy, and it's about moving your positions and your options, and that's part of it. That can be a valuable, it's proven to be valuable that having an adjustment technique and a management technique, where you place your spreads, how you combine your spreads, offsetting and hedging to create a flatter profile, things like that does add value compared to very simplistic trades like an iron condor. Using good risk reward, using stop losses, things like that. Those things add value that's been proven in backtesting and in live trading. But what I'm going to look at is to get that more consistent return, to reduce the amount of drawdowns that you experience when the market does like it did in August, like it's acting like it wants to do right now with a recent 5% correction from the most recent rally. We're getting these 5% swings in the market, and in a lower volatility market, something that looks similar on the chart takes up as much room. A number of green days, a number of red days may only represent 2.5% in the market. So consistent returns and being consistent about controlling drawdowns and the size of drawdowns, I feel like has a lot to do with being consistent in your modeling and in how much risk reward you have. I was watching a presentation that Mike Bellafiore did, and his insights are amazing. If you've ever had the opportunity to meet with him personally and work with him, I feel like even at that level, it's even more inspiring, and the inspiration comes from the Rolodex that he has, the people that he interacts with on a daily basis at a very, very high level throughout the trading world, the professional trading world. And one of the quotes he threw out there in a recent presentation I was watching is that every trader wants to trade bigger that he's ever worked with. They all imagine doing the same thing that they're doing now, but doing it at X multiples in size, taking much bigger size in what they're doing. And that's the same for options traders, futures, stock, day traders, doesn't matter, that we imagine and we even do the math on the back of a napkin or in an Excel sheet, and we look forward to our success being compounded to the point that in my world, I'm raising money. In other traders' worlds, it's being more confident, so they're more willing to put more of their personal capital at risk. Or even better is when you can take trading capital and compound it and put it back to work and trade at bigger size. But the one non-starter that happens is, if you do not control risk at the smallest size, you cannot control risk, and you cannot ever expect to trade very large size in the future. So I'm going to show you a couple of ways that I define risk in a different way than is typical, I believe. It's not using margin. It's not using buying power. We're not talking about the difference between the credit received and the amount of the spread width. We're not talking about the debit versus the in-the-money intrinsic value. We're not talking about any of that. We're talking about expected movements and expected risk over time, and defining that as the denominator, and then defining a different type of numerator for your return, which is your expected value of the trade over time, not necessarily at expiration and not necessarily based on delta, since we are really more expecting our profits to come from premium decay. So to get, if consistency is desired, then consistency should be modeled. So modeling consistency, I will bring up a thing in a minute, a risk analysis chart, and we'll look at that and show you what I mean in a picture format. But what I'm looking for when I'm modeling risk is I'm asking myself on a daily basis, if the market moves within a certain amount, and then I have to define what that amount is. It used to be I would look at something as a percent basis. So if the market moves 1% tomorrow, what's my risk? If the market, from the time I put the trade on, that's one way that's often looked at. If the market moves X standard deviations or a half standard deviation per day, if it moves 2 standard deviations while the trade is on, what's my risk? But what I've found over time is some of those are, in some ways, are too simplistic, and they're not showing us the reality of our risk-reward in trades that we're in, especially ones that we don't take to expiration. So I'll show you a picture of that here in a second. The reason why some of the ways that the software we have that we look at, maybe conventional wisdom that we've heard that talks about our risk, how we define risk, how our broker tells us our risk is defined, which is by margin, typically, which margin can change as the market moves. So how do we define risk in a way that's more consistent so that we can have more consistent reductions in drawdown and consistent returns? So I'm looking for the risk in trades over time, not just from day to day. I'm not looking at risk as a measurement of delta, because delta changes for every 1 point change in the market. And delta changes as time changes. And theta increases as days go by. So a delta, over managing delta, if you are one that feels like you've ever struggled to maintain a low delta in your options profiles, and you're always fighting to have a low delta, my backtesting and study and comparison of my trading in different accounts where I would work toward a low delta versus another one where I would use this multiple time frame kind of three-dimensional look at risk versus reward and just let the trade go inside of that environment. If with the ones that I let go inside of the environment of good risk reward, as defined by current volatility in the market, expected profit potential within a certain range over the life of the trade that I plan to be in, versus the amount of risk that I'm taking within a certain movement of the market over the life of the trade, because risk changes as time goes by. The wings of your profiles change. They move up and down based on the amount of time that will go by in the trade. So defining the total risk expected, the total reward that's possible, and then just letting a trade work within anywhere I have good risk reward, let the trade float. Let it go, let it move around, and move incrementally based on moving averages, reversion to the mean expectations, not chasing price, not chasing the noise of the market, but just holding this range and having a good risk reward in that range. My adjustment frequency plummeted. The amount of trades that I have to do and the amount of adjustments that I make is much lower. The number of winning months that I have is higher. The drawdowns that I experience are lower as I use volatility-based sizing and filters to reduce the size of my trades. The over management and over adjusting of trades is dropped because I use filters to make sure I don't chase price as it moves too far from the mean. Things like that. So I'll go over some of that. But risk changes over time. So what I'm going to show is a fluid and constant way to look at what I call risk versus reward. And I've written it this way for myself. I don't think I ever shared it this way, but it's just one way that I like to write risk versus reward, or the risk-reward ratio. I like to put a lowercase r and an uppercase r. And the lowercase r is my risk, and my uppercase r is the reward. And it's just a visual way for me to remember the risk should always, the expected risk. In many options trades, the actual calculated risk will be higher, but the expected risk within any type of normal movement from day to day should be a lower amount than your expected return. Maybe not each day, but over the amount of time you expect to be in the trade. All right, so that slide's doubled, so we'll go to the next one. The purpose is to adapt. This is actually, I kept this from the previous time I was on capital discussions. The purpose of this is to adapt to markets and market conditions completely objectively. And so that's that. And I'm going to bring up and try to model from scratch a profile. All right, we've got enough people in here. So what I'm going to ask is, just so I'm speaking in the context of what everybody works with, just type into the chat the simplest one or two words that describes the trade that you use. Is it an M3, a bearish butterfly, a broken wing butterfly, rhino? That's a great one. Just recently learned about the rhino. Beautiful concept. Who made the rhino trade?
That was Brian Larson.
Okay, yeah. That's not who I saw present it, but that's... Love that concept. All right. We have the capital efficient M3. John, you exceeded the 2-word maximum. I'm just joking. So rhino, which is basically a broken wing butterfly with a call calendar. Kevlar's broken wing butterfly, iron butterfly, M3. So all butterflies, and we got a weird or mixed in. Good. So these are all trades that kind of define what I was saying is something I'd rather focus on, which is your potential reward is typically higher than something like a high probability spread. So what I'm going to look at, I would say a standard butterfly was probably the most common. So I'm going to model one of those. It's not really a good timed expiration, but we'll just do 40. All right. So I'm just going to throw on a butterfly, add some size to it, and maybe to satisfy the broken wing crew, make it just a little broken here. So it's got this kind of even amount of risk reward from day to day. All right, so looks pretty familiar. I'm not an option view guy. I just have not ever been, but I know that's probably, if I was to poll for that, I would take a guess that 80% of the audience here is option view oriented, but I do know a lot of traders are in thinkorswim, so this should look at least familiar that way. Very common way to look at the market is to use a T+0 line and the expiration graph. Another common thing to do, and I already have these in here, but another common thing to do is to look like this light gray area and this dark gray area is showing me the 68% chance of expiring in this range before, ending in this range at expiration. So that's a common thing to look at, and look outside at this point and say, okay, that's where the amount of risk I have. And then we come in and we look at the theta delta ratio, very common things. I do believe there is value in all of those metrics, but what I want to plant in your minds is possibly another way to look at risk reward that you can take, maybe go make it your own. I'd love to hear from you and get your ideas about how you would change this, but this comes from my study. I've done a lot of spreadsheets. I'm going to see if one will pull up very quickly, if it's still, yeah, that'll load in a second. So just so I can show you that this is not based on just, standing in the shower thinking, oh, I'm just going to try to look at my chart a little bit different this way. But this actually comes from a lot of work. So here's a spreadsheet that I've done that takes about, I think it was 10 or 15 years of the Russell 2000, and I analyzed the ATR, and I put in a number of conditions that said, if the current trend is down based on momentum, what is the change in ATR expectation, the median, the 10th percentile, 90th percentile, max, and minimum. If the ATR is higher than X percent of the market, what's the typical ATR range for the following day? So I've done a lot of this ATR study to figure out normalized expected movement from day to day in the market, and also looking for little edges, looking for typical where, the next day, when all things are equal, the expected move from day to day, or the median move from day to day, is 0.06 ATRs up. If just looking over the last 15 years, whatever this data is, I don't remember, it's 15, I don't think it got to 20, but about 15 years, if you just take the median move of every single day, it's about 0.06, so 6% of an ATR to the upside. That's just that tiny little upward edge in the market that's gone up typically over the last number of decades. But I go through here and I look for all these conditions. I'm looking for conditions with enough data samples. So here's one that doesn't have a lot of data samples. I'm not impressed with that one. Where this one has a lot of data samples. If I see a lot of data samples where I start to see a bigger edge in the market, where the median move is typically higher, the biggest move to the downside and the 10th percentile move, which would be 90% of the time the market moves not as far down as that. If I start to see the 10th percentile and the minimum or the maximum down move from day to day start to be smaller based on certain conditions, then I take note of that. When I've used percentage movements instead of ATRs, the numbers are all over the place. But when I use ATRs, it normalizes it. It becomes this unit. I'm kind of zoomed out, but I'll zoom in a little bit. You start to see this number of units, and you start thinking differently than points in the market. Because if you're in the SPX, 20 points is a lot different than 20 points in the RUT. If you're analyzing the Russell 2000 when it was at 700, that's a lot different than analyzing the Russell 2000 when it's at 1200. And these moves in the market, when you just look at them as point-based moves, points don't really mean anything. It might sound like a lot. 20 points sounds like a lot. But if it's a low volatility environment and you're in a lower priced index or a lower priced stock, 20 points is enormous. If you're in a high volatility market, in a high priced stock or index, 20 points is nothing. So I want to normalize what I should expect to see from day to day. Percentage moves are very similar. High volatility markets, 3% a day, no big deal. It's just like it was the last several days. Whereas market's very quiet, you may only expect to see 0.75% in either direction. So a way to normalize that is to use ATRs. Also, standard deviation is pretty good, but standard deviation does seem to be a little bit more erratic. ATRs, if you just look at it on a chart, it's a very constant way of kind of identifying typical movements in the market. So I'm using ATRs. I've done these studies. I've seen that across the board in all market environments, the biggest move to the downside does not exceed or has not exceeded historically 4 ATRs to the downside. 90% of the time, we barely achieve more than 1 ATR to the downside, regardless of market conditions, whether it's a downtrend, an uptrend, low volatility, high volatility, etc., because ATR automatically adapts to changing volatility in the market. Ron, I use just a 14-day look back. For this, I could spend time optimizing that maybe for the number of days that I'm actually in the trade, but 14 seems to work fine as the standard. So high volatility markets, it's still 1 ATR downside move is your 90% chance of staying less, no moves bigger than that. Low volatility markets, ATR drops, so it's still about 1 ATR to the downside. Across the board is where it lines up, and with small little edges. Here, when momentum is down, it can be a slightly bigger move. That means literally the momentum indicator, the 12-bar momentum look back. When that's higher, there has been bigger moves to the downside. When we're below the 9-period moving average, there's been bigger moves to the downside. When we're above, there's been less than average, less than typical. The typical is 1.01. I'm sorry, 1.06 is the typical, only 0.98 if we're in an uptrend. Same thing if we are exceedingly overbought. This is a very valuable bit of information. So if we're 1 ATR above the 9-period moving average, which is a pretty sharp move, we can get 1 ATR above a 20-bar moving average pretty easily because a 20-bar moving average is slow. 9 is faster. It follows price. So for us to be 1 ATR above the 9 moving average, or exponential average, by the way, that would be a very fast move away from that. Often the chatter comes in, how quick can the correction come? This data shows that not very quickly. You would not expect to see a quick move back to the downside. In fact, the down moves are much smaller after that, and so are the up moves. You're just expecting contraction in daily movements from there. So I've done a lot of this study, and I do plan on building out more charts, I guess you could say, or tables to kind of look at different market conditions. But I did all of this just to find trends, just to see in the typical types of moves to expect. And I'm not going to overanalyze that. But it's just so you know that it's more than just this feeling about ATRs. I've really dissected ATR movement. I've dissected the different market conditions and seen that ATR is very reliable to tell me typically you don't go more than 2.5 ATRs up. Typically you don't go more than, never has the market moved more than 2.6 ATRs up from yesterday's close, and never has the market moved more than 4 ATRs down from the previous close. That's the never. Then I get into the percentiles, which they're defined over here. So 10th to 90th percentile. And I have that same, never has the market gone more than, 90% of the time, the market does not move more than 1.06 ATRs to the downside and not more than 0.99 to the upside. That's over time. And then these certain market conditions, downtrends, if we're in a downtrend, that move can be a little bit bigger. If we're in an uptrend or the market's overbought, then it tends to be smaller in both directions. So these tendencies, when the market's moving up, expected move for the next day may be a little smaller. Market's moving down, volatility is increasing. Expected move for the next day should be getting higher. And I don't just mean number of points, I mean as a multiplier of ATR. Okay, so that's ATR. So I'm going to go back to this and say, well, what's our standard look here? Our standard, or what naturally happens when we look at this risk profile. We naturally want to look toward break-even points. We naturally want to look toward where this line stops sloping down and turns to this side, and we look at this and defines an amount of risk. So I say, okay, right there is $40,700 in risk. And I can say break-even point would be about $47 to the downside, $45, $46 to the downside. So I start just because those are there visually. There's markings there. The software has put this red hash mark there. They've put this gray hash mark or this gray color change right here. We've been conditioned to look to those levels and say, well, I'm going to start doing some math based on these levels. We're given a theta number. Say I'm going to start using theta as some type of measurement for my expected return because I'm making money based on theta. I'm going to try to keep delta flat because I want to be market neutral. I want to make theta and I don't want to lose on delta. And I don't want to depend on being right. These are natural things that looking at a risk profile like this can make us do math on because we're looking, that's the data that we're given. That's the type of information that we're given. So just checking the time, make sure I'm not going too slow. What I'm doing now, this type of analysis that I'm doing, and I really look forward to hearing from you and how you might adapt this and change this for your trades. I saw Nagaraj is here today, so Nagaraj is going to, if Nagaraj is at all interested in adapting his risk profile to look like this at all, he'll have to do it much differently than me because he uses weekly trades. And I'm looking at increments of sets of 10 days, so looking out 10, 20, 30 days into the future, and that wouldn't work. So another thing we see here is this expiration graph, the expiration profile. And so we, at some point, we all have a daydream of what would it be like to just let this go to expiration and pin at 11.39 and 99 cents. And you just say, oh, could I be brave enough to do that? Could I let it happen? Wouldn't that be fun? So we have that there, and we see, okay, well, if the market comes to this point, we're trying to figure out math based on this profile, the T+0 line, the theta, the delta, these indications of break-even points and standard deviation moves at expiration, by the way, which here I will poll this. How many of you trade and let your trades go to expiration? Say yes if you go to if you tend to trade into expiration with your profile, and say no if you do not. Okay. And I do like the sometimes answers because I sometimes let contracts go to expiration, but I never have the same trade that I put on day one go to expiration. It'll either be a very small remainder of that trade, or it will be some random contracts that were just not worth closing because they were long contracts that were worth 10 cents or something. So, or I was a 300 lot butterfly and I have two of them that I just let go because I'm trying to pin those last two in the middle and have some fun with them. So we have a bunch of no's. So looking at this, looking at a standard deviation expected move over the life of the trade at expiration, which is what that's giving us, is not, I don't think it's giving me the information that I need to see for making decisions about my risk reward. So here's what I've been doing instead. What I'm doing, and this is a trade, I think I put it on 43 days. I'm even going to bump that out. I'm just going to change this. It's a little far out there, but I'll do it anyways. I'm still getting used to the new format, Thinkorswim. All right, so I'm going to do a February trade way out there. So what I'm doing here now is to calculate out, I need a denominator and I need a numerator, because a constant good risk reward is all it takes to be a consistently profitable trader. That is, that's paraphrasing something that Bella also said in the same presentation about that all traders want to trade bigger. But the only way to do that is to constantly and consistently have good risk reward. And I want to objectively quantify good risk reward, and I want to know that I can maintain it throughout the life of my trade. And I don't want to do it using the standard tools that are handed to me in the brokerage software or in the analysis software. I want to use metrics that I'm actually going to experience during this trade, or I expect to experience during this trade. I'm not taking it to expiration, so I don't need an expiration graph. This is probably going to be, this was a weird thing for me to do, but I've done it. I no longer, at this point, I do for fun for a few seconds at a time, but I now actually remove the expiration graph from my profile. It doesn't add value to me. because I'm not taking the trade to expiration. I need to know what is possible for risk and reward while I'm going to have the trade on. I need to define over time. I'll show you in a second, Daryl. I need to define over time how much risk I'm going to have based on these ATR moves, based on a certain percentage move, etc. Breaking support, whatever you want to bring in. If you don't want to use ATR daily movements and you want to use technical analysis, that's great. I think that's extremely valuable to look at support, resistance, trend direction, etc. and saying anywhere in this range because of support and resistance, my risk reward is X, or my risk is lowercase x, my reward is uppercase Y, and within that I'm good. If we break support, then I can make these adjustments and change my profile, etc. That's great trade planning. I think that's extremely valuable. John Locke gets into that in great detail in the M21 course as well, and I think that style of trading is really what gets you to the advanced higher level of options trading to become consistent, and also the exciting part, if you plan your trade well and you execute it that way and things work out, you can make much more than a trade that would be considered just purely market neutral. So that's a great way to trade, and I think that's extremely valuable. But in a simple way of looking at it, while I'm in the trade, I want to define how much potential risk I have from day to day, and I can manage it from day to day. I can't manage it from minute to minute. And I want to only look at my potential reward and risk while the trade is going to be on. So here's what I've been doing. And this is available, I think, in Option View as well. What I've done is I go to a day step. And I'm going to go to a 3-day step because I'm going to plan to be in this trade for 30 days. And I change the steps to 10. And then, let's see if I have something here to give me the updated ATR. Detach. It's on its way over. Okay, now I need to give myself a range, and my range is going to be defined by ATR. ATR has been rising in the Russell as we've been having increased volatility. So our lowest point was 13, and that popped very quickly to 14, and is actually at 15.5 now. Momentum has turned down, so I can actually expect a little bit higher multiplier of evenness. So not only has ATR risen, momentum is down, so I can expect the daily move tomorrow, up or down, to be up 80% of the time. It should be less than 1.5 ATRs in either direction. If momentum was rising in the ATR, well, it doesn't matter what the ATR is. If momentum was rising, we're above the moving averages, I could actually reduce that to be a little bit less than 1 ATR, and the ATR would be a smaller number. So I could expect less movement in the market. So that's just a little how I'm interpreting that data that I pulled earlier. So 15.5 is all I need to know for now. And so I can go in here and say, okay, 100% of the time historically, the market has not risen more than 2.5 times ATR the next day. So I'm going to do 15.5 times, and I'm sure somebody's done it in their head already, but I just want to be careful. 2.5. So it'll be a 38, which is actually right where we are already. So 30, whoops, that's 28. 38-point move. So 100% of the time in the last 15 years, from here to here, the market did not rise past this level on a volatility-based way. Has the market moved more than 40, what is this? Oh, it's right in front of me. Has the market moved more than 38 points up in one day historically? Yes. But the market was much more volatile at that time, and I don't need to use that information right now, I don't think. So I'm using a volatility-based level. It says ATR is lower, moderate right now. It's not extremely low, but it's lower than extreme. It's 15.5 points. 2.5 ATRs up would be 38. Somebody can type in the math if I've done that wrong while I'm talking and trying to do math. So I can say with pretty good confidence that tomorrow's lowercase r, tomorrow's denominator of risk to the upside is, where is it? $1,300. Okay, and I'm not worried quite yet about volatility and Vega and stuff like that. I'm just looking at, or even theta, which should come into that as well. But I'm just looking at it simply as this a very simple profile. Then I can go to the other direction and say it's 15.5 points. Where's my spreadsheet? Because I already forgot. Is it? Oh, it's right above next screen. Yeah, four to the downside. We're below the 190 moving average, so it actually reduces it because that means ATR is a larger number. So typically, your multiplier goes down. But 4 would be the biggest. Momentum's down, so I actually have another 3.25 is the biggest. Below the 9, 3.25 is the biggest. So I'm looking for all the conditions we have right now to kind of set the bottom to see if it can be less than 4. And right now, we're not 2 ATRs below. That wouldn't matter. 9 moving average is not rising at this current point in time. ATR is not less than 1.5% of the market. I don't think 15.5 divided by 1145. That's 1.3. So we actually are right there. So we do have one circumstance in here where ATR was close to 4, so I'll use it. So 4 times 15.5 is 62 points to the downside. So I can set my downside to 62 points. So now I have this 100% of the time historically, based on volatility, based on ATR movements, a $1,300 risk to the upside, and a $3,300 risk to the downside, knowing that I am using a higher number of points to the downside, because downside moves are typically faster than the upside moves, so that's why we have a little bit more room to the downside calculated there. So what I can do now, and this is something I've actually yet to define myself. Right now I'm just making sure that this number, whatever this is, 3,400 and 1,300, right now, one hard and fast rule that I have in trading is that 30 days from now, either one of two things, where the market is currently or the 9-period moving average, one of those two, 9, and that's exponential, 9 exponential average or the current market price has to be, 30 days from now, a higher potential return than 100% of the ATR expected moves for tomorrow. So that is that maintenance of good risk reward. So right now on this profile, regardless of what it was, I threw on a butterfly, I made the debit half of the butterfly a little bit narrower to kind of emulate something between all of the trades that most of us look at. Shows me that a $5,400 return during the life of the trade. So everything goes perfect, and we sit in a 20-point range from 1160 and change. Let's see. Yeah, whatever. Just say 1170 down to 1120. And say we just float in this range for the next 30 days. Christmas, New Year's goes by. Market's quiet, no major announcements, no major world events, no terrorism attacks, and we just float around, and then boom, I get a nice solid trade for close to 5,000, and the risk that I was taking from day to day during that trade, obviously if we floated down, there might be a little more risk to find over here, but I'm always going to maintain that as well. I have this potential for return that's higher than my day-to-day risk. Now then what I do is I go from day to day as the market moves, I constantly evaluate that. Now one thing I'm going to also do is I'm going to filter out the 9-period exponential average. So Tom mentioned that before the meeting started, that was brought up in the last time I was here, and I bring it up in chats and conversations that I have with traders about that being a good way to avoid chasing the market. Let me see if I can find my, here it is. So 9 moving average, I make this big, maximize. Okay, 9 moving average. I wish I could just hide it without getting rid of it, but it's this blue line here that follows price more closely. If we look at this, blue line here, this becomes a great way that when the market's dipping down fast and the 9-period moving average isn't following close behind, that we can often find ourselves just as far on the opposite side of it in very short order. We see here is this sharp move up. If you were to maintain this idea that this is noise and the 9-period moving average is a filtered or smoothed way of looking at where the current market price is, it can help you avoid adjusting this trade all the way up to 1266, which is typically how it works. You adjust it down, the market's dropping, you kind of ignore it, you're trying to not over adjust, and then it gaps down hard one day. The next day you see that it wicks through the bottom, and right there you have the highest number of people jumping in, moving their positions that they felt like they should have adjusted 3 days ago. They're moving them down, and they're moving them down further than they would have if they had done it 3 days ago. And then we get the sharp rise back, not only that, but to a new high. And so first it bounces up, and you wait, you start adjusting, and then boom, big gap up. Next day, I don't even pick this on purpose, starts to break above higher again, and then you adjust all the way up there. And you're recentering your risk and your profile up at 1265. So you've recentered from 1200 to up to 60 points higher than that. But if you had this constant kind of this slower look at the middle of price, you see that from the highest point, the 9-period moving average was at 1233, and the lowest point was at 1223, and then all the way up here, 1252. So I'm going to take our biggest range here is a 35-point, oops, it kind of snapped onto something wrong there. 30-point range rather than a 52-point range. So if you were moving around and kind of expecting the middle of your risk reward, so that same look we're seeing here, if I was saying, I'm looking at this, basically the 9-period moving average is kind of my center point, and I want the 9-period moving average to represent the bulk of this peak area up here. I think I can draw up here. Yeah, let me do this. And by the way, we're not, because the market's so far below the 9 moving average, this actually wouldn't be represented right now very well. So what I'm going to do is I'm actually going to pretend like I'm going to make adjustments to get this right. 9-period moving average is up here in right around 1170. Current market's here. Biggest expected move from here, based on ATRs, would be from this point to this point. But ultimately, I'm kind of expecting I need to control risk here, and I need to control risk here, and I want to have peak profit somewhere between where we are and the 9-period moving average, and about as far as we are to the other side as well. So I really probably want my risk reward, my reward centered up here, and then I need my risk probably reduced down here, and I need that risk is fine up there. I could probably take a little bit more up there if I have more reward that direction, but it would just be shifted up. So let's see if I can stop annotating. Do you know how to do that, Tom? Oh, I'll just click on it again. Yeah. So 1170 is where the 9 moving average is. And if I want to, like this is a position I'm modeling, obviously. But if I would not take what I currently have on and adjust it down to look like this. I believe and feel like that would be over adjusting. So I could probably assume that maybe even a little further. This is probably something that I more have on right now, which is a great example. It's good timing that we're in a kind of a steeper move right now. We have a steeper decline happening, and we are a further distance from the 9-period moving average. And because of that, that shows me now that maybe I'm centered where I think this is the more probable area for us to kind of float back to. But right now, I'm also seeing that I have more risk than potential reward on this analysis. If we sit still, I have less return than potential risk. And even if we go back to where I think we should go, I still have less return than potential risk on the downside. So I would and this comes back to what I'm talking about, is I'm aiming for smaller adjustments, less frequent adjustments, as long as I have good risk reward. If you think a 45 positive delta versus a 102 theta is bad risk reward, I've just moved further away from worrying about that. And my experience over the last year and a half has rewarded that with less frequent adjustments and good returns. So what could I do here? Well, that's where we get to go shopping. And I probably don't want to take too much time for that, but the net effect of whatever I'm doing would be I can obviously take a little more risk up into the 1190, 1200 area because I don't expect to get there very quickly. I do expect maybe a little bit more of a drift back to 1170, but right now I just need to lift up this side of the trade I need to change this risk reward so that this risk is not greater than this, and I want to do it in a way that does not drop this down. So if I'm trying to make 5,000 on this trade in this account, I don't want to lift up from 5,500. I don't want to lift that up to be 4,500 or 4,000 at the expense of moving my return down to 3,000. That has not changed my risk reward. I need to change the relationship of the reward where we're sitting now or up to the 9-period moving average, and the risk that I have for the ATR multiplied, expected potential move to the downside. And even though that's 100% of the time we've not exceeded this, or basically we've hardly ever made it to that level, what I'm assuming is that we could make it some good distance in that direction, and then we could gap the next day. So I might only get some of my adjustments done, and we keep going after that. That's why I like to continue to use that 100% of the time we've stayed within this range for one day. I'd rather look at that and just use that as my day-to-day management. So I guess I could try to do a couple of things. I could widen the spread to the upside. So what I did is I just moved the in-the-money puts up a few dollars. And that's my first guess to see what I can come up with here. So if I did that, my risk to the upside, I'm going to take more risk to the upside. But at 1170, at the 9-period moving average, I'm not happy because I'm starting to not have peak returns. So I feel like that was probably an over-adjustment. What I could maybe do is move half of them. So I'll simulate that here with the 1210, the 1220, 1210. Or maybe I just do a few of them. So I'm looking for is where we are up to the 9-period moving average to be my peak return, not today, not tomorrow, but 30 days from now. I'm looking out in time, 30 days from now, so that looks good. And then that expected move to the downside is now better, but not quite there, 6,400. So I'm just going to keep massaging this. Maybe something like this is getting better. Another alternative is I could close some of these and open them up down lower. So there's a lot of other things I can do, but I'm going to try to do it as few contracts as possible, incrementally, making sure that I get to a point where my risk reward is good. At some point, I do think that when we're extended far below the means, I'm going to worry a little bit less about making sure that this is a great relationship here. And then as the 9-period moving average follows price, which is confirmation. If we have a sharp move down and we're starting to trade in a range and then we start to move down again, the 9-period moving average is going to start following that very quickly. So as it follows, my expectation of where price is going to settle is going to start to get lowered. So if the 9-period moving average starts moving down $5 a day, a few days from now, I'm going to start assuming the peak risk reward is at 1150, which means I can move this whole trade down and balance out my risk reward again. So for those that like color by number and, trade steps and lot sizes and if-then scenarios for every adjustment, I have not satisfied you today, maybe even irritated you a little because you just don't see how this is applicable. But if you have a color by number strategy, or you have a certain trade that you like and rules based on it, I would encourage you and challenge you to maybe consider looking at I've shown a lot of things here, but looking at this 30-day step analysis, you could either just use 30 days. So what you can do is you do a day step, one time, 30 points. So there you go. That's even simpler. And you could say 30 days from now, not expiration. I'm not worried about expiration because I'm not taking it to expiration. But 30 days from now, where will my account theoretically be if we stay in this range between where we are and the 9 moving average, or my expectation of the range, or my technical analysis prediction of the range, or assumption of the range. And then I'm going to use statistics based on current volatility of the market to say, what's my day-to-day risk reward? And right now, not so much upside risk, but I do feel like there's more upside in the market because of the extended current move to the downside. I can incrementally follow that down if it keeps going. Maybe this is a little too much risk right here, but it's comfortable. I can put in a couple more of these and lower that a little bit. Even better, I'm starting to think, is maybe wider and not so far in the money. Here we go. That was better. So what I did is I put it more toward at the money, widened it out, and did fewer contracts. So now I've got this over 6,000 peak and a 5,000 risk to the downside, which I'm a little more accepting of downside risk right now based on the current move, and minimal amounts of risk to the upside compared to my potential return. So everywhere in this kind of expected range, I have good risk reward. The market moves sharply to the downside, I'm all right. And that just looks a lot different than this. I don't feel like this gives me the same information because I'm not going to hold the trade for 40-something days, or what is this? 71 days. I'm not going to hold the trade for 71 days. I don't think the 9-period moving average has any weight on what the market's going to do over the next 70 or 80 days. So this risk reward doesn't tell me anything because that's not the life of this trade. If I was trading 80 days expiration, I would probably hold it for 30 days, kick it back out. At least I have a completely different profile 30 days from now and start trading smaller, and then reset and go from there. Another aspect of this is every day I reset this. Every day, and the way I do that is I look at the P&L on the day. And this is a lot different than the profiles I look at and see shared in chats as well, where typically we're tracking the P&L of the current trade. So we're looking at the trade, we're showing how much is the trade down, how much is the trade up. Very common, very good way to control risk to see if you're too far out of line, or if you have a lot of profit, maybe you keep it. A big adjustment that I've made over the last 6 months or so is zero-based thinking. Every day is a new start. From 9:30 in the morning for the next 24 hours, I start at 0. I place my P&L at 0. I ignore anything else. I place my multipliers of ATR in either direction for the next 24 hours at whatever I expect them to be, and I decide the amount of risk that is. I look 30 days out from where we are right now. Regardless of how much P&L I have for the month, I'm looking at the next 30 days. How much return can I get over the next 30 days? That's going to start giving you a lot different decisions. If you're up a lot in the trade and you're outside of your tent and there's not a lot to be made over the next 30 days, in fact, you actually can start losing over the next 30 days, you're going to see that show up in an analysis like this, where looking at theta and delta is not going to tell you that, because your theta is not going to grow anymore. If you're already up a lot and you're outside of your tent, your theta will not continue to accelerate. If you're inside the tent, it can accelerate. You have more upside during the trade. But you're going to start to see the wings dip down, one ATR move, or the expected multiplier of ATRs, so 2.5 ATRs up, 3, 4 ATRs down. It's going to start to show you a lot more risk and a lot less return 30 days from now. So you're going to start rethinking that risk reward over the life of that trade. Okay. Volatility.
Nice presentation.
Hey, thanks. Should we go through the questions, or do you want to cut off the time?
Probably where Daryl, he asked about if you'd make the TOS workspace available on the spreadsheet.
Say that one more time.
Oh, Daryl's asking if you could make the TOS workspace available, and could you share the Excel spreadsheet?
Okay, cost workspace, I don't know if it would save the price slices, but I will try. And then the spreadsheet I will do. Let me do this. Just making a note. ATR spreadsheet.
And if you just send those to me, I can attach them to the recording and people can download.
Yep, I'll share that and people can dig through that as well. I did see this question here. Ron, how are you defining being too far, in quotes, away from the 9 EMA? I love that question. That is what I love to ask myself and kind of challenge other people to define these terms such as too far, because I want to be completely objective. Too far to me is a bad term, and I apologize for using that term. It's completely useless, and there's no way to apply that to your trading. So good catch. That said, what I would look at is where is the 9-period moving average? Where is price? Is the current, if we were to quickly get back to the 9-period exponential moving average, exponential and simple are very close, so it's not that big a difference, but if we were to get back to the 9 exponential average tomorrow, very quickly, would you, because of your adjustment, now incur a second loss? So if the market quickly ran away from the 9-period moving average and you have a drawdown, and then you make adjustments in that drawdown, and you do an adjustment that sets you up to lose again if we quickly get back to the 9-period moving average. That, to me, is over-adjusting, whipsaw trading, chasing noise, chasing the market, and not letting just good risk-reward and good old-fashioned premium decay to work over a monthly trade. 2 days down, away from the mean, some excitement, some headlines. That is not a reason to me to completely abandon a monthly trade that has good risk-reward within the current range of the market. If the average price of the market starts to move down and the whole range of the market starts to move down, then yes, I'm going to follow that down. So too far really is, if it's below the 9-period moving average, the studies that I have done algorithmically in TradeStation, writing code and script, pulling out tabular data and doing analysis, when you're below the 9-period moving average, the edge starts to move in your favor to get back to it. If you're above the 9-period moving average, it's a little different. It's actually kind of this very flat edge where there's really not much risk-reward in either direction. So it's a very kind of neutral stance, this grinding kind of condition in the market. But if you're extended, 1 ATR, half an ATR, 1.5 ATRs below the 9-period moving average, leaving room in your P&L and in your profile to get back to the 9-period moving average, and then the same distance on the other side of the 9-period moving average is very prudent to me. So I think that was a great question to bring up.
Franz says volatility can change and all your work will be a waste of time, but you do this every day, right?
Every day I do it, and volatility changes over time. So the work that I'm doing changes daily. So the work I just did, this 38 points up, 62 points down, if the volatility changes and we re-enter an August environment, in the first quarter of 2016 is very volatile. The ATR is going to represent that incrementally on a daily basis. The ATR will rise. My multiplication of ATR won't have to change because it's the same regardless of what ATR is, historically speaking. So I'm just going to take 4 ATRs down, 2.5 ATRs up. If ATRs are getting bigger every day, my expected range of movement every day is going to change. And what happens is, this is hopefully one of the biggest takeaways to start thinking about. When volatility increases and you're using this type of analysis, you're going to objectively and instinctively, it's not even instinctively, what's the term? Your reaction without emotion is going to be to reduce size in your trading. It's not going to have to be something that you decide that the headlines that you are seeing are indicative of a higher volatility market, so you're going to make this judgment call to reduce size. You don't have to do that. You don't have to depend on your ability to do that. If ATR is rising and you use a multiplier of ATR to define the amount of risk you expect to see from day to day, you define that amount of risk as some percentage of your assets. You define that amount of risk based on your potential return in the trade. If it ever gets so high that you can't make it a good risk reward, you probably need to bail out of that trade and go out to a later dated option. So now you're taking, again, less risk. You're objectively and automatically taking the right amount of risk for the current market environment. We've done surveys at SMB, sent them out to the entire thousands of options traders on our list, and we asked them, what is it that you're trying to get better at? What is it that you've already gotten better at? One of the biggest, number one, is consistency. That's always comes back. I want to be more consistent. They know how to make money, but they want to make it more consistent. Number two, recognize changing conditions in the market. Maybe it's not number two, but it's in the top 5. Recognize changing conditions in the market. And that is an unqualified term. We don't have a way of identifying how to do that, what they're trying to achieve there. But what I'm offering here in this way of doing some math on the market is going to give you an objective way to adapt changing conditions in the market by using a multiplier of ATR, by defining that as in a certain amount of risk from day to day, not worrying about your expiration profile, but worrying about as long as you're going to be in the trade, do you have a good enough amount of return to accept the amount of daily risk? Do you have a good strategic adjustment methodology, which that's where the M3 comes in, that's where the Kevlar comes in, that's where the Weirdor comes in, the Jeep trade comes in. Those are the adjustment techniques that you can use. That's where you get the value from those strategies. But now how do we start defining good risk reward? That's all I got.
Great.
I got to go to a Christmas program at church.
Oh, so you're out of time?
I'm out of time, yeah.
Okay, well, there's a couple more questions. Maybe I can send those to you via email, maybe.
Yeah, let's do that. I was going to put my email in, but I like the idea better. Email Tom. He will send them to me. I will reply one time, and then he will post them with the recording. I think that makes it easier for everybody to see all the information in the same place.
Great. Andrew, thanks very much for all your time and nice presentation. Lots of food for thought.
Thanks for having me.
Have fun at your party, and we'll see you next time, everyone.
All right.
All right.
See you around.
Bye.